Good day. My name is Jeff Jenkins. I am the Executive Director for the Texas Chiropractic Association, and I want to welcome you to today's webinar, our Lunch with TCA webinar series, Releasing the Burden of Student Loan Debt with Tony Ferra of TCA Friend of Chiropractic Partner, Student Loan Tutor. Our website is produced by TCA's Next Gen DCs Committee, which is dedicated to providing valuable resources, information, networking to chiropractic students and DCs in their first 5 years of practice. They do a lot of cool things, which you'll learn more about. But before I do that, I have a couple of quick announcements to make. Our next webinar will take place a week from today. That's Wednesday, January 24th. Our TCA lobbyist and attorney, Josh Massengale, will present Demystifying the Corporate Transparency Act, which is a new thing, which took effect on January 1st. It will significantly impact millions of unsuspecting small business owners, including chiropractors. So if you own a chiropractic practice, you should log in, register, log in, and watch that webinar. I do want to mention that registration is now open for our 2024 TCA West Texas Conference, which is going to be on March 22nd through 24th at the Cotton Court Hotel in Lubbock. You can earn all your 16C hours in one weekend, including the board hours and acupuncture. We have some incredible speakers, and this is going to be the only TCA conference that is hybrid, so you can attend in person or virtually, so take advantage of that. Registration is open right now, so go to the TCA website. I also want you to put this date on your calendar. Chirotexpo 24 is our TCA state convention. That'll be June 28th through 30th at the Hyatt Regency Frisco. Registration will open next month, so stay tuned for more details. There will be some next-gen activities at that event, which I know you want to be a part of. We do have another webinar series in a few weeks. It is going to be for CAs and chiropractic assistants with Gold Star Medical Business Services, so more details to come on that. Lastly, I want to mention that this webinar is being recorded, so you can revisit the content and share it with your fellow DCs. You'll be able to ask our speaker questions today, so type them in the Q&A box at the bottom, and Dr. Mees and I will get to it at the end of the webinar. So now it's my pleasure to introduce you guys to Dr. Sammy Mees. She is a chiropractor from Georgetown, Texas, Texas Chiropractic College graduate, and also chair of our TCA Next Gen DCs Committee. Dr. Mees, are you in your third year chairing the committee, a second or third? Fourth. Okay. I knew it'd been a while.
It has.
So anyway, the growth of the Next Gen is due a lot to this woman's energy, and she really cares about you, new chiropractors and students. So I'm going to turn it over to Dr. Mees. You guys enjoy the webinar.
Awesome. Thank you, Jeff. Hi, everyone. The TCA Next Gen DCs Committee is committed to helping the next generation of DCs, you guys, succeed in practice and life. We offer opportunities to learn, grow, and network through our webinars, Next Gen DC socials events like Chirotexpo, as Jeff mentioned a little bit earlier. It costs hundreds of thousands of dollars to attend chiropractic college, and student debt is something that keeps every student in DC awake at night, and I can vouch for that. But there are ways to tackle your student loan debt, and we are excited to have Student Loan Tutor today to share a few ideas. Let me introduce you to our speaker. Tony Ferra has been with Student Loan Tutor since it was founded in 2015 and is the sales director and tutor department manager for the company. He has almost 2 decades of sales and management experience with background in finance. Tony is a U.S. Navy veteran. Thank you for your service. Went to University of Northern Colorado for business administration and finance. Is a licensed accident and life insurance agent and lives in Western New York with his wife, son, and their Cocker Spaniel, Pepper. Today, Tony will provide an overview of how federal student loans operate and the best way to maximize the benefits and savings. Let's find out how to get out of that debt from a leading expert. If you have questions during this webinar, please put it in the Q&A box below, and then we will ask those questions for you. But for now, Tony Ferra, take it away and welcome.
Thank you, Doc. I appreciate you, and happy that we get you out of your student loan debt as well. So
absolutely, thank you.
I know you're speaking from experience, and I see a couple of names on here that are with us already. So appreciate you all taking the time. So yes, I appreciate the introduction. We love TCA. You guys are our favorite partner by far. Always love coming down to Texas and hanging out with y'all. So to dive into this thing, and folks, I'm happy to answer questions as we go. If there's something that pertains, so feel free to, pop things in the chat here and whatever we can do to assist. Um, so let's see. So right off the bat here, folks, student loans, what we work with primarily is federal student loans. Unfortunately, we're not able to help with private student loans. We'll give you some resources if you do have private loans, but and how to treat those. But to dive into this thing, here at Student Loan Tutor, we've been around since 2015. We actually have about, well, see, I didn't update this. We have about 3,600 clients right now. A plus Better Business Bureau rated, almost 5-star review, almost. Very, very big fan. But ultimately what we want to do here is we want to lower monthly payments on federal student loan debt. Reduce that monthly payment as close to zero as possible to free up cash flow and still get years toward loan forgiveness with income driven repayment plans. The primary goal is to reduce your overall loan cost long term, and not looking at this like a traditional finance model, but looking at it as these programs are implemented. So minimize interest accrual, maximize loan forgiveness, and mitigate the tax burden overall. And then, most importantly, avoiding mistakes, right? So these, anytime there's a mistake, it can cost you thousands of dollars in the long run, kicking you out of the plan, capitalizing interest. But ultimately, like I said, if you're forced to play the game, it pays to know the rules. So with federal student loans, obviously, as Dr. Meese, pointed out that, student or education is expensive anymore, especially for chiropractors. We see a 7 to 8% increase in tuition every year, gone up more than 550% since the 1980s. So definitely a different game than what it used to be. Now, couple updates right now that's going on with federal student loans. Payments did kick back in October, and then September is of 2023 is when interest on student loans started to accrue again. You might have noticed some changes in your loan servicer as far as who's handling your loans. So right now there are Nelnet, Mohila, Ed Financial, and Aidvantage are the only 4. And then there's also a one-time account adjustment in place with the Department of Education through April 30th of this year. So they extended that from the December 31st deadline, pushed it out a little bit further. Not sure if it's going to get extended again, but in July of 2024, there are new guidelines going into place as well, where even with a consolidation, they're still going to take a weighted average interest of, or a weighted average of previous payments. So we'll see what happens after April 30th for that, basically 3-month gap, what they're going to do. So essentially what this one-time account adjustment is the Department of Education is going to backdate any months in active repayment status, regardless of payments made, loan type, or repayment plan. Any months in deferment except in school status, and then any 12 or more consecutive months of forbearance or 36 months of cumulative forbearance prior to March of 2020 when COVID first went into play. They would take those as eligible repayment months toward your total 20 to 25 year for income driven plans. So if you have loans in the mix, from late 90s or early 2000s, you could be close to the finish line of being done with this. So if you do have student loans, you're not in an income driven plan, and you do not have all direct loans, which we'll go over here in a second, definitely want to get that underway and consolidated before April 30th to maximize all your benefits. Now, kind of, 5 tips to win here, right? Number one, know the rules, the different repayment plans, your eligibility, how you're allowed to report income documentation and household size. Make sure you know what type of loans that you have, if they're federal, student loans, public, or if you have private loans. Looking at current income and how you document income, and you want to play to win, right? So think like a CPA with this, like an accountant would, to mitigate, taxes and find all your expenses. Is the same thing that we do with student loans. You want to know when to fold them, right? So if you have, loan forgiveness, when that's coming up, if you're a public service loan forgiveness, meaning you're working 30 hours a week full time as a W-2 employee for a 501c3 nonprofit or government entity. Texas also has some rules where if they don't allow, a W-2 employee, you could still qualify as an independent contractor for public service loan forgiveness. Know when to refinance if you have, a substantial income. Really, there's no point to ever refinance federal student loans unless you're rolling in it like Scrooge McDuck. Okay. And then ultimately compound your winnings here, right? Get your money working for you versus, frivolous donations to Uncle Sam with predatory interest rates. So to jump into this thing, with federal student loan types, right? So there's different loan types depending on when you had those loans dispersed. So, prior to 2011, there were federal family education loans, FFEL. These ones are only eligible for income-based and income contingent repayment. You would need to consolidate these into a direct loan. Direct loans are the only loans that they've dispersed after 2011. So these have the most flexibility and eligibility for the different programs with income driven. You have Perkins loans, which are dispersed directly through the college or the university. They're still federal, but these would need to be consolidated as well into direct loans. And then, Parent Plus loans. So if you took loans out on behalf of your children, we have something called the double consolidation, which is a loophole that the Department of Education is fully aware of, and they're closing down July of 2025. So if you have Parent Plus loans already, don't consolidate them until you talk to a professional on the best way to manage those. And then a few lesser known loan types, HEAL loans prior to 1995. So, whatever the situation is with federal student loans, we're able to assist with those and make sure that you get those into the direct loan status for the most flexibility of income driven plans. So if you do have private loans, because we know college is expensive, and then the way that they, allow you to borrow, so maybe have some private loans from undergrad. The best thing to do, and this is really the only time that I would ever want you to refinance, is if you do have private loans, just to get the lowest interest rate, and then treat your private loans like they're your worst enemy and pay these things off as fast as humanly possible. And we don't have any affiliations built out with some of these companies, but Citizens Bank, SoFi, and Earnest would be the top 3 to go through as far as the lowest interest rate and then most options for any private loans. Now, when it comes to federal student loan debt, there are 10 different repayment options available, just because why not make it easy, right? So we want you to view your repayment options more or less a fork in the road scenario. So you have balance-based repayment options, which would work like, traditional finance model, mortgage, car, personal loans, credit cards, best to pay these things off as fast as possible if you're looking to pay them off in full. Very expensive because you are paying off 100% of the balance plus interest. And the only time to go down a balance-based repayment option is if you are no longer able to save money from these income-driven plans. So really, if you're making $600,000 a year on salary as a W-2 employee, you win the lottery or you find a leprechaun in your backyard, by all means, knock these things out of the park. But if that's not in the foreseeable future, the next 48 hours, the income driven repayment options are going to be your best bet. So with these income driven plans, unlike traditional finance, monthly payments with income driven are based on a percentage of discretionary income. So any money that you show above poverty guideline as it relates to household size and income, and your monthly payments with these programs can be as low as $0 per month and still count toward forgiveness. Now, these programs range anywhere from 20 to 25 years, depending on the program, if they're undergrad only, or if you have graduate loans in the mix, typically 25 years. And they do require an annual recertification to update household size and income. And then at the end of the term, whatever the remaining balance of the loan, principal plus accrued interest, is forgiven or canceled, kind of like you won money on a game show that year. So let's see. I see a question popped up. So if you consolidated 23 years ago, Dr. Will, we might want to do another consolidation right now. And then everything would be backdated. So we'll bring this up at the end of the call for sure. But more than likely, if you consolidated 23 years ago, you should be close to forgiveness already. But we want to make sure that we reconsolidate if they're federal family education loans into a direct loan. And the best way to go about that is log into studentaid.gov, which I'll put in here as well. And we'll make sure that you're good to go. Now, with income driven repayment programs, okay, I don't know why I did that. So the newest and most advantageous plan is called SAVE. So this replaced Revise Pay As You Earn in July. So a few days after our conference in Dallas is when they rolled this out, after the Supreme Court shut down the Biden forgiveness of 10 to 20,000, which we knew didn't have a snowball's chance, but A for effort. But this new SAVE plan that replaced Revise Pay As You Earn, this one is the best plan, hands down. Number one, it's going to take the lowest percentage of discretionary income at 10%. So it's assessing 10% of any money that you show above poverty guideline at 225%, right? So that means anything that we show over 2.25 times broke, which, just to kind of give you an idea here of what that would look like. So for a household size of 1, anything above 32,805 would require payment. Anything below that would be 0, versus any of the other plans that it would be at 21,870. So definitely gives you a lot more earning threshold before a payment's due. Now, the other benefit to SAVE, and the reason it's the go-to strategy, is because this is the only program with a built-in interest forgiveness subsidy, where 100% of any leftover interest after payments is automatically forgiven every month by the Department of Education. So theoretically, if you can keep a $0 monthly payment, that means that your loans would be interest free, right? So huge benefit across the board versus any of the other programs. What most borrowers are on with income driven plans is income based repayment. This one is 15% of any money above 150% of poverty. There's no interest forgiveness subsidy. This is the only plan eligible for field loans. You have Pay As You Earn and IBR for new borrowers, which is essentially the same plan. They just rolled out two different ones. So if you're eligible for IBR for new borrowers, you're also eligible for pay as you earn. This one is a 20-year repayment plan. There are, regardless of undergrad or graduate loans, but this one takes 10% of 150% of poverty. So the reason that the save plan for 25 years is the go-to is because you'd much rather go 25 years of potentially no interest rather than 20 years at full when it comes to paying taxes on these loans, which we'll get into. If you have Parent Plus loans already and you've already fully consolidated those, the only plan eligible for those is income contingent repayment. This one is the original plan that was rolled out in 1994. So this one takes 20% at any discretionary income above poverty guideline, right at broke. And then public service loan forgiveness. So 10 years if you're working for a 501c3 nonprofit or government entity, working full-time at least 30 hours a week, then there's no federal taxes after 10 years or 120 months. They would be fully forgiven. So, and when we speak individually, we'll go through exactly the situation that you're on. This is just more or less high-level overview to encompass everything for all borrowers. Now, when it comes to the calculation of your payments with income-driven plans, like I said, income-driven repayment plans are going to take a percentage of, discretionary income. So any taxable income above 100% to 225, depending on the plan. So your factors here is, for determining payments is what percentage of discretionary income that it's taking, your household size under the Department of Education's guidelines, which is different than the IRS as far as who you can claim on taxes as dependents, and how you're allowed to document your income. So either, linking tax returns from the previous year or a manual documentation of income with a pay stub or a letter. And then when it comes to household size, the Department of Education, like I said, is different than the IRS as far as who you can claim on taxes as dependents. So it also has a change if you filed married separately on taxes. You would not have to include spousal income, but you don't get to count your spouse's household size, right? And then if you're filing jointly on taxes, they want to see spousal income unless you do what's called no reasonable access to funds, where you didn't have any joint bank accounts with your spouse and they're unwilling to sign your application. So therefore, if you didn't have, joint accounts, you had separate accounts, you wouldn't have reasonable access to those funds. And I don't know about you, but I cannot pull money out of an account my name is not on. So we'll get into that in more detail on the one-on-ones. Now, family size with the Department of Education states anybody that you support 50% of the time or more on a monthly basis, whether they're relatives or non-relatives, you can count as household size, as long as they live with you half of the time and will continue to live with you for the year that you file. Okay, definition of support is not strictly financial. It includes services, errands, gifts, money, loans, food, car, clothing, insurance, college tuition, you name it. If that individual is receiving half of their support from you, you'd want to count them. You can always count children, even if they're not living with you, if you feel that you support them 50% of the time. Excuse me. They count active pregnancies. So as long you can count, pregnancies as an increase in household size. If you're having that child the year that you file. So like I said, we're going to maximize all qualifying household activity to increase earning threshold before a payment's due. And every increase in household size is going to increase earning by $11,565 for the year. So in turn, really what that does is every increase would reduce your monthly payment about $96 a month from every increase. So we'll look at maximizing all qualifying household activity. Now, when it comes to your income, this is where it gets, really the bread and butter here. So typically the Department of Education wants you to link taxes from the previous year. But they have to have a one size fits all for all 43 million borrowers, right? So the options with the Department of Education, you can use taxes from really the previous 2 years because not everybody files. So if you didn't file, say, 2022, or you haven't filed 2023 yet, you could still use 21 or 22. Taxable income is any income from employment, unemployment income, dividend income, interest that's reported for the month. So you don't need to do any supplemental security income, any child support or assistance. You have the option to write a letter if you're not on payroll, or if you don't get a physical, payroll check from your employer. You can draft what's called a self-certified declaration of income, where you'd state, I'm self-employed if you're self-employed, or I get paid X for the month, and then your employer would sign that off. Or you can use one pay stub, and whatever documentation that you use cannot be older than 90 days from the date that you sign the income-driven repayment plan. So with the right on the application, just to kind of give you some insight here, the Department of Education states anytime that there's a significant decrease in income, they want to know about it. They don't say anything about increase. And because you're preparing for the next 12 months of payments, you want to make sure you can pay the legally obligated minimum, right? So if you've lost your job or you've experienced a drop in income, very ambiguous statement, the Department of Education says that you can use a pay stub or a letter, one piece of documentation for each source of taxable income, dated no older than 90 days from the date that you sign this form. So if you had a low paycheck because you took an unpaid vacation, or you didn't pay yourself as much because you needed to purchase things for the practice and keep working capital in the account, they're only asking for one pay stub within a 90-day period of time prior to submitting this form. Now, there are options. So if you are married filing jointly and you had separate bank accounts, or you're willing to separate those accounts and not include spousal income, therefore monthly payments are solely based on your income alone, is usually the best option for most borrowers. Therefore, your spouse would not affect your monthly student loan calculation. So going back to the SAVE plan, okay, this is the go-to strategy, I would say 99% of the time, which, loans would have to be direct. So if you're not on direct loans already, or if you have any kind of variance within student loan repayment history, best to do a full consolidation right now. But like I said, this program is going to subsidize 100% of any extra interest that accrues after payments. So if you're not paying off 100% of the interest accrual on a monthly basis, which student loan interest is front end loaded, right? 100% of any leftover interest after payments fully forgiven, no taxes on that, goes away automatically. But this one is going to be the best program to increase your cash flow from lower monthly payments and really put that back into yourself and your business to help you grow, in personal and business life. So I know I keep talking about this tax implication here. So with federal student loans, at the end of the term, right? So with SAVE 25 years, 300 total on-time eligible payments, even at zero, still counts. The remaining balance of the loan is going to be forgiven or canceled as earned income. So you'd receive a 1099-C from the Department of Education, kind of like you won money on a game show that year. Okay, so with this, you figure at the highest tax bracket as it stands today, 37%. If your earned income year 25 plus the remaining balance of the loan exceeded the highest tax bracket, the most you're ever going to spend on these loans is 37 cents on the dollar. So if you had 100,000 at the end forgiven, right, and you're able to keep a $0 payment or whatever the case is, the only thing that you'd pay at the end to the IRS as, you know, forgiven debt would be $37,000. So heck of a lot better than, you know, paying off 100% of anything plus interest. So when we ask you to never pay more than the legally obligated minimum required by the servicer, please don't, because it doesn't do you any benefit whatsoever. And these are operate like that distant cousin that doesn't play by the rules and should not be treated like a traditional finance model. Um, Now, with these income driven plans, you do have an annual reporting that's due. Okay. So, um, we've seen upwards of lately about 85% error rate with the servicers. In 2019, they had a report from the inspector general that it was a 61% error rate from the servicers, which is insane that it's worse than meteorologists, but you know, makes sense for the, you know, minimum wage employees at the servicers that are not incentivized to have your best interests in mind, right? They're basically like bank tellers that process paperwork. But this is why we do everything for our clients on a yearly basis to make sure that everything is submitted, accepted on a yearly basis. So that way you don't get kicked out of the plan. You don't have interest capitalized, meaning the principal balance, or excuse me, the outstanding interest becomes part of the principal balance, kind of like taking out a brand new loan. And even if it's no fault of your own and your servicer drops the ball, you as the borrower still get penalized with that outstanding interest becoming part of the principal. So typically processing takes anywhere from 30 days to 120 days, depending on the initial consolidation processes. But every year we would reach out 4 months ahead of time with an email, call and text in 90 days to get everything in, submitted, accepted without a hitch. And the servicers have a new rule where you need to make sure that everything is submitted 30 days prior to that anniversary date of your plan acceptance in order to get processed in time for the following 12 months of payments. So, you know, biggest thing is just cover your assets on this, make sure everything's done, set up correctly every year. So that way there's no mistakes that can be made and you know what your trajectory is going to be long term. Um, Now, with that capitalization of interest here that I was going over, we want to avoid any forbearance or deferment. Okay. We don't want to do any future plan changes after whatever we put in place, unless there's a new plan that comes out and is even better. If you've been with us for a couple years already, and you were already on the revised pays you weren't plan, since that got taken over by Save, that had automatically shifted over. But if you're not in the Save plan already, that would be like the only plan change that you want to do. And then we don't want to consolidate it in the future again, because that capitalizes. But if it's going to be in your benefit to take advantage of the new changes with student loans, it's best to consolidate to get into Save and then know exactly where you're going to be at long term. But ultimately, here, you know, we never want you late on an annual recertification that's due every year to update household size and income. And when you're on a forbearance, interest still accrues, and those months don't count toward your overall 20 to 25 year forgiveness. So if you're having a rough month or whatever the case is, it's best to do a recalculation to reduce monthly payments further versus putting it on a forbearance and then going back to paying what you should have. Okay. So, like I said, preparing for the tax implication at the end, we definitely want you to work with a financial advisor. You know, if you have one, excellent. If not, we have an in-house financial advising team that can help you out with preparing for the taxes. We have tax professionals as well that can help you out with that on a yearly basis. And you know, like I said, just making sure that you're set up for success and have your money in some kind of interest yielding account. Um, you know, so essentially redirect the money that you would be spending, put that into an interest yielding account to have it work for you to prepare for the taxes long term here is going to be much better off. So, for instance, you know, if you're looking to prepare for 100,000 at the end, and you had a full 25 years to put money in, you could end up putting in somewhere about 3/4 of what you would need to pay out overall just by having your money work for you. And I believe that's all I have here. So with our fees here at Student Loan Tutor, our first year we charge $1,800 for everything. So that is, consultation, implementing the strategy, consolidations, all the paperwork, the whole nine. We do have payment plans available, and then ongoing every year is $600 for the year or $400 for the year with a referral that becomes a client. And being part of TCA, we typically charge $150 deposit to have the hour-and-a-half consultation, but because of TCA, we waive that for you. So that way you can get a free consultation, and if it works, great, we move forward. If not, you knew more than what you did going into this. But really all I have on that one, and happy to answer any questions here, folks.
Awesome. Thank you, Tony, for this great information. I know you have helped me and still currently are. And if you guys have any questions, please put it in the chat box below. And while we're waiting on those, Tony, I'm actually going to ask you the same question I asked you in case anyone was thinking the same thing, I was. Obviously, I'm married, and I had asked you, for student loan tutor, currently, before we were working with you, me and my husband were filing separately. What about, how does that affect going forward with you with someone who is married in my position?
Yeah, so if you're filing separately on taxes, with the new SAVE program here, let me get this pulled up. If you filed separately on taxes, SAVE plan excludes spousal income for borrowers who are married and file taxes separately. So therefore, you could keep joint bank accounts don't matter, assets, what have you. So really want to check with a tax professional to see what the delta is, right, versus filing jointly and filing separately. So if you have borrowers that you're filing jointly already, take a look at what the difference in taxes would be overall, especially if your spouse has a viable income. If they're making even 40 grand a year, right, that's going to negate the savings that you get of $96 a month. They're going to cost you a few $100 a year or a few $100 a month in payments. So therefore, if filing separately makes more sense, if you can't separate bank accounts, but the other option that you have with student loans, right here on the application, it states that they're only looking for marital status initially, right? So you can file, your options are single, married but separated, or unable to reasonably access your spouse's income information. So I'm not an attorney, I cannot give legal advice, but most of our clients that have spoken with our attorney have stated if they had separate bank accounts, not a joint account that their income is being deposited into, then you would not have reasonable access to those funds. Right. And like I said, I don't know about you, but I cannot pull money out of an account my name is not on. So therefore, you could file married jointly, have your cake and eat it too if you separate, funds, right? So you wouldn't have your name on your spouse's account and vice versa. If you're not married and you have a partner, right, you can still count your partner as far as increase in household size, but you don't have to include their income because you're not legally married. Right. And once again, right here on the application for, their household size, it says that for SAVE, your family size includes your spouse unless your spouse's income is excluded from the calculation of payment. Okay. So we just want to make sure that everything's done on the up and up, either file separately. I don't care what y'all do with bank accounts, or if you're filing jointly, separate bank accounts. So that way you don't have reasonable access to those funds.
Okay, awesome. We got a couple more questions in. Does your in-house finance team include tax specialists?
Yes. So we have a separate part of the company called Tax Tutor. So we have a wonderful tax professional. He works off the gift. So he doesn't have a fixed rate. It's kind of like you pay him whatever he thinks fair and conducive for time and energy, which is wonderful and a very strange monologue in the tax realm. But if you're going to TurboTax or you're paying a ridiculous amount of money for an accountant, it's whatever you feel that his services are worth. And then our in-house financial team, full financial advisors. So, securities, insurance, setting up Roth IRAs, brokerage accounts. We literally do it all, and we can take over anything that you've been working with a financial partner, but we don't charge anything extra for that service as well. So
Okay.
that's
Awesome.
kind of included here. And then let's see.
We have, what is the process to set up a consultation with you?
Yes, so we have a link directly for TCA. So let me get that pulled up here. I had that ready. Let's see. Remove all these boxes out of the way here. Pretty sure we did. And I'll plug that here into the chat for you guys too. Let me get to the link. And then you want to post that right in the webinar? Okay. Right. So here is the link in the chat box. So it's calendly.com/free evaluation. And Raven, yes, I can refund that, but that $150 goes toward your first year fee as well. So if you've already paid that, it's fully refundable if you don't learn anything or we're unable to help and can't do anything. Happy to take care of that. So I'll get you the link, Raven. I'll look at your thing and I'll send you an email with the booking link without the deposit.
Awesome.
For the consultation.
All right. Thank you for that question, Miss Raven. If there's any more questions, go ahead and post those now. Just want to say on behalf of TCA and the TCA Next Gen DCs Committee, thank you again for joining us. We hope you sign up and attend next Wednesday's Lunch with TCA webinar with Josh Massengill, and we hope to see you at the West Texas Conference. Thank you again, Tony Ferra, for taking your time and helping our students and DCs in this heckle of death with chiropractic. So definitely appreciate it.
Absolutely. Well, happy to be here and help out your members. You guys are wonderful.
Yes, and I understand that you're going to be at our Texpo this summer, correct?
Yes, I will be joining myself and my team because we love coming down and hanging out. So
we love having you. You've been a good asset to TCA. And there are no more questions. So if there's anything else you want to say, we'll go ahead and call it a day.
Thanks, everyone.
All right.